welcome everyone. Thank you for joining us. We have a diverse panel here, which is nice because we're going to try and hit a couple different spots within the multifamily sector. I'm in the investment sales and finance business for Newmark Knight Frank. I oversee the state of Florida for our brokerage practice and have been in the business now, in the multifamily business. Next year will be my 30th anniversary. So I think, you know, listening to Mark earlier and seeing those cycles up on the board, you always think you've seen everything, but you know, I'm sure there'll be something new that'll come up. We have a team. We cover the state of Florida with offices in South Florida, Tampa, Orlando, Jacksonville, and you know, last year we did about $4.1 billion in transactions. We have a very good pulse on the market and what's happening within the capital markets in the multifamily space. Mischelle Padgett to my left she's a regional manager for ZRS, which is an affiliate of Zom Living. Zom Living is premier apartment development company, celebrating its 40th anniversary in business, so they're true professionals, and the products that they build are just spectacular. So Mischelle kind of oversees this Central Florida from Tampa, Orlando, and Lakeland, and Ocala, right. So she's got a good handle from the property management side of the business as to what she sees relative to trends and changes that are happening in the market. Brian Lott to my right is the vice president with Covenant Capital. Covenant, as many of you know, Rick Scarola, who's a board member, has been a long time contributor to the program, long-time board member to the program, based in Nashville, and their group you just closed your latest fund for Fund 9 for 400.
395.
So they specialize in the value add space, which has been white hot probably for the last 5-6 years. Tremendous opportunity. It's white hot because it has proven itself out time and time again. And you know, it requires a real expertise to execute the value add strategy. So Brian will touch on that element. And down, certainly not last but not least, is my longtime friend, Tim Peterson. And Tim basically started with Altman Development Company about, what, 13, 14 years ago?
Actually 15, coming on 16.
So next year will be my 20th year doing business with Altman. Very similar situation relative to a development company that actually celebrating its 50th year, I think this year, anniversary.
Last year, 51.
Yeah. So, and also a developer that builds absolute state-of-the-art premier residential communities, very, very active in the state of Florida. So he can give us a really good perspective as to what he's seeing on the development side. You know, Mark touched on it a little bit. Dirk did as well. It's almost like nobody wants to talk about 2009, but it was pivotal for the impact that it's had on the residential industry. Because if you do go back, and I go back to this conference 10 years ago with a small group of people sitting up in a room much smaller than this in Gainesville, which was the board members. And we're all there like deer in headlights, you know, wondering we're all, you know, it's a closed door session. What is going on? And that session, unlike this one, was moderated by Steve Cohen, and he walks in the room from the back with the Grim Reaper costume, dressed in a Grim Reaper costume. And we're all just, you know, if you remember, Tim, it was just scary. It was really, really scary time. in not only in our industry, but in the world. So of course, you know, late in 2008, Lehman filed for bankruptcy. And then shortly thereafter, Bear Stearns fell, and it was just a contagion that occurred thereafter. You know, to give you an idea of how severe it is, we look hard at job growth in our industry, in the apartment business. But we lost in 08, 3.5 million jobs, and 09, 5 million. So, you know, we talk about the demographics, and our population is you know, comprised of, let's call it 320 million. It's kind of a rough number. 80 million of the 320 are baby boomers, give or take. The other 80 million are millennials. So those two cohorts are the two huge ends of the barbell. They represent 50% of the US population. So back in 09, if you were to take the middle of the millennial cohort, they were 21 years old. So the average millennial, and obviously that cohort, you know, is a 10-year generation, they're coming out of school wondering, what am I going to do? There were no jobs. I mean, not only is there job creation, but there's people losing their jobs, right? And then you layer on top of that the boomers. So the average boomer age today for that cohort is 63. So the boomers were 53 10 years ago, and had about 5 or 6 years of free money just showing up in their mailboxes every 2 weeks to pile on to their home equity loans, and all you had to do was fog a mirror, and that was it to get that money. But and that was because real estate prices were appreciating so fast at that point in time that everybody thought it was just going to keep going. And of course, the music stopped in 09, and prices collapsed. Everybody was way over leveraged and being foreclosed on, losing their homes, and on and on and on. And they all turned into renters. So back at that point in time, you know, the US population, they thought owning homes was the best thing to do long term. But at that point in time, it was the worst thing you could have done, was own a home. So people turned into renters, not by choice, but by absolute necessity. So from that, then we move forward, and we come into where we are today. And so, you know, I've got kind of, because of the demographic that now, very interestingly enough, the millennials are, or the young people, I hate to, you know, label them like that, but they are now, because of the expansion we've had in the economy, getting jobs. And they are able to move out from mom and dad's basement. And so that's starting to create true demand for the apartment business, and has been for the last 3-4 years, as they have been able to decouple from living at home. Interestingly, there are still 1 million of that cohort still living at home, but it is now happening to where they're able to come in and get real jobs and then move into apartments. At the same time, the boomers, surprisingly to a lot of developers, are showing up in the leasing offices. And that very possibly is because they're now able to sell their house, because we've been in a strong residential market for the last 4 or 5 years. And companies like Zom and Altman and many others that you know, we're working with constantly are creating product that you walk into and you go, ah, I get it. I would live here in a minute with everything that they provide, the services, the units. They're just spectacular. So the availability of supply to appeal to the boomer is causing them to come in and look hard at renting. So you have a convergence of two demographics now becoming very active simultaneously in the rental business, or in the rental industry. So I thought for both Mischelle on the property management side and Tim, that we could open up the discussion about how are you seeing this impact what you're designing, what you're building, how you're managing this dynamic that's occurring?
Well, for us on the side of management, we really see them wanting the same things. You know, they want convenience, they want walkability, they want socialization. They're going there, especially the boomers, to be able to meet and find things to do within the community. So we're trying to provide the same services, but with the millennials, they want everything quick, very little human interaction. So we're gearing our leasing platforms to being able to do everything with a click on your phone. Most of our millennials are wanting to lease, view the apartments, lease the apartments, pay for their fees. They're basically doing it all by their phone with a one click, and they're just showing up for keys. And with our boomers, they still want the phone call, and they want the interaction, they want the connection between the leasing agent. So we're having to gear two sales strategies, one to the boomers, one to the millennials, and is still, you know, of course, keep high quality, but find a way to mix and match both so that, you know, we meet the needs of all of our residents.
Okay, thank you.
I would agree. Mischelle hit it. They both want a lot of the same things. If you look at the millennials that are now 10 years out of college, what do they have? They have more income. They have dual incomes in most cases, and they still don't have kids. So they've got more disposable income. You go to the other end of the spectrum, what do the baby boomers have? Well, they finally got the kids out of the house, and they have more income because they're not paying for private schools and college and that, and they really, speaking from personal experience, want to give up the big house because they've been in it for 20 years and everything now breaks, and they don't use that space. So they've got more disposable income, and they want services and quality, and we've seen that our Altice Boca community, we literally have residents from 20 years old to 98 years old in the same community and pretty peacefully coexisting. But what we found was tremendous demand for services. There's a blowout bar. There's a plunge pool. Obviously, you've got the workout center, the indoor, the outdoor pool with the whole cabana and cooktop that's become standard. But we're all in an arms race for more and more services and amenities. And the other thing that's come into the arms race in the past 2 to 3 years is how can we make things more convenient for our residents? And Mischelle hit on a bunch of them, but that also goes to the walkability and the location. One of the things that made our Boca community so successful is we took the land down in partnership with Schmier and Fury, great retail developers. They put a Whole Foods literally 25 yards from our community, and a whole strip center of, I literally told 100 people, if I could just write down my dream list of tenants, from Chipotle to Burton's and everything in between, they're all right there. But it's also, you're trying to do more and more and more, and Joel Altman, our founder and chairman, is always telling our leasing staff, focus on finding a way to say yes to your residents. And that becomes a challenge at a point. Literally at Boca, we have residents call down, can the maintenance guy go get my lunch for me at Habit Burger? Well, why not? I'll buy him a sandwich too. But the other thing we're doing, there's been a move into, for many of our compatriots, into age-restricted housing. I know Kyle's got a great project up in North Palm Beach County that they're about to start was, we actually took a slightly different tact, partially maybe because we weren't as brave as to go pure deed restricted. In our building, when we looked at a site up in Pasco County, we were trying to we loved the location, loved what was being built around it, but we're concerned about supply and competitive advantage, and so we brought, is Leslie Deutsch in the audience? Well, Leslie's a great market analyst. If you haven't used her, you should. And she started talking to us about the number of retirees, but young retirees in their late 50s, early 60s that were moving into the southern Pasco area. And this was our third community we would be developing there in the last few years. And we looked in the other two communities, and we had around 15% in each of them without even marketing. So we came up with what we call an age-targeted product. And of the 350 units, we're going to do 120 age-targeted in an elevator-served building connected to the clubhouse, doubling the size of the clubhouse, adding a card room, we're adding a craft room, we're going to have a full-time concierge cruise director to do some of those things. And actually, if I could sum up in one word to meet both, how many folks here are familiar with pickleball? Pickleball. Going to bring everybody together and lace your apartments up.
All right, Tim, thanks. So I'm gonna turn over to Brian to talk a little bit about the value add space. You know, these newer products that the developer's been building at the top end of the marketplace, not everybody can afford them, obviously. So a lot of sponsors and operators saw this opportunity emerge to where they would come in and buy older assets and study the markets and understand the position of the property relative to the market and apply capital to upgrade it, and then be able to access premium rents in doing that program. It's complicated, obviously, because you've got a typical apartment, 250 to 350 units on average, garden deal. And why don't you talk to us a little bit about the market, what your experience has been, if people are out there considering maybe doing a value add project, what words of wisdom would you give them? And
sure. So for us, we're still very excited about what we're seeing out there in the market. Everyone talks about the demand for renters is huge. We focus in the Southeast, and all these markets have tremendous job growth, and there's really an affordability crisis in almost all of these cities. And while we're not an affordable fund by any means, but we feel good about the basis that we're buying these deals in. And a typical deal for us, we'll buy any aged asset, but down the middle for us is sort of a 70s, 80s built deal with in-place rents from $600 to $1,000. And we can buy these deals, put $13,000, $14,000 a unit into them, and at the end of the day, in-place rents are sort of $1,000 to $1,400. For us, we like being in that position. We feel that that's an affordable rent for most teachers, nurses, young people if they're coming out of their basement or trying to separate from a roommate. We're still not top of the market. We're underwriting rents that exist today in the marketplace. And for us, we can buy below replacement cost, and going in cap rates have gotten more competitive. But for us, we really don't look at the going in cap rate very much. We're like a developer, we're redeveloping assets. And so we sit there and say, what revenue should this bring in? This property in this location, this unit mix, and how much money is it going to take to get it to that position? Is it if there's obsolescence or something we can't solve for, it's not for us, but most of the deals you can solve at a certain number, you can get it to a certain point, and we can still value add to an 8 or 9 stable cap rate year 3, and we like that basis. Again, we're below replacement costs. We do have to constantly work on our execution. You're going in, you're spending money, you're going in, today we go into people's existing apartments and renovate while people live there. So, we're trying to refine our process, we're trying to get our speed faster, trying to get our costs down to be more efficient with how we do that. So, to win deals for us, a lot of it is, we believe, our execution, or, we can do the same rehab, we believe, for less expensive than most operators, a little faster than others. But we haven't changed our strategy. It's still, that's down the middle for us. We might buy some deals where we'll do $3,000-4,000 a unit rehab and, get $100. But most of the deals we buy are a little bit heavier lifting than that. We've done well in a lot of downtowns, buying these they tend to be 60s built mid-rise deals in downtown Nashville or downtown Louisville or Knoxville, or these markets where we can buy these deals that are just as good of a location as the new deal. We're buying them below replacement, and we don't have every bell and whistle, but we're still serving, and you can get a huge rent pop in these locations and be very walkable. So we've done a lot more of those in recent years. And so for us, it's really just studying the markets that we're going into. We haven't changed the strategy. We may shift markets from time to time. That's something we don't property manage. We partner with ZRS and a lot of other managers to help us do these deals, but we want to be able to come and go from markets as we see opportunity. And so for us, it's just a financial decision. We don't have any people in any of these markets. And so we're really doing the same thing we have been. We've opened up our footprint a little bit more. We just closed a deal in northern Alexandria, Virginia, which is not a market we had been in previously. It's another one of these 60s mid-rise deals that we're excited about. Huge differential in rents between us and everything else that's getting built in that area. So we like that spread. And a couple minutes from Crystal City, and we lucked out there with Amazon. And we'll start buying in Texas, is another market we hadn't been in previously. But for us, the execution's been the same, and again, we feel good about buying below replacement, underwriting to rents that are existing in the marketplace today. We're still well below the top of the market rents in any given city. And so, we're conscious of development, but we're not competing with lease-ups with the deals. Even after we do our value-add product, we're still at a different rent range for what we're delivering.
Okay. So this is a breakout session. Please feel free, while we're kind of talking, if you have a question, raise your hand, and we'll be happy to try and address it for you. So I'm going to toss this one to Mischelle. Obviously, we're in an incredibly disruptive, state with all the different changes that have been happening from a technological standpoint, electrical cars, ride sharing, VRBO, and some of the other, vacation rentals that you're seeing popping up in apartments, and just so many changes that have occurred just in the last few years. I would think from an operational standpoint, it's got to get complicated, right? With dealing with the social media and talk to us a little bit about what your experience has been from the operations side and the management side.
Sure. Well, what we're finding is that most of the people that come to our communities now, they've done the research online. They've taken the virtual tour, they've chosen their apartment, they've chosen the features that they want in their apartment already, and probably 30% of the cases they've already paid, and they're just showing up for keys. So we're finding with our leasing agents, for example, there's less of a push for them to be sales agents and more to provide convenience for people to make the whole process easy. So they're showing up. I mean, we still have the sales aspect, especially with our boomers, but they're having to manage both roles, I guess, and be able to make the whole process convenient and seamless, and navigate all of the social media and all of the leasing platforms that are all online. Now we do a lot of instant messaging with prospects, or texting is big. We'll do lease paperwork through texting now, and that was never the case. I got into the business 30 years ago, and we didn't even have computers in our offices back in those days. It's a whole different leasing job. Now they're required to post on Facebook, on Instagram, any social media platform. It's just their day-to-day. They're required to do all of those things, and they seem to love it, especially our millennials. It seems to be the way they've learned to operate. And so that's really what we focus on, is making the whole platform and experience convenient and quick, and still provide good service.
Any questions for Mischelle?
I have a question for Brian. Where do you, on your renovations, where's the 13 grand going?
Yeah, for an average deal, I'd say, 8 to 10,000 for the apartment itself, and 3 to 5,000 for exteriors and amenities. On an average deal, we'll do, a standard turn for us is, granite countertops, stainless steel appliances, vinyl floor, paint, and then, lights, blinds, faucets, all those things. That's probably $8,000. If it doesn't have washer dryer connections or other things, that'll drive that higher, obviously, or if you need to open up a kitchen or change the floor plan or something like that, those are some variables that'll affect that. And then, exteriors, kind of standard, does it have a clubhouse or does it need a better clubhouse? Windows, roofs, you can spend as much or as little as you need, but on average, 3,000. If we always add either connections or machines in all of our units.
Question for Mischelle. They mentioned in the previous presentation that the operating expenses reduced because turnover had decreased. I wondered if you had seen that, and to a point where you've been able to quantify or if that's more present in one demographic versus another,
Well, in terms of, turnover is probably on average for our properties right around 60%. Our retention is about 60%, about 40% turnover. I don't know that I've seen a decrease in operation expenses, other than perhaps I do a lot of renovation work with Covenant, and so we're putting a lot of new features in these apartments, so we have a little bit less in the turn costs. But in terms of the social media and the marketing platforms, that's probably gone up a little bit, because to compete, you really need to be touching a little bit of everything. So we do find with our internet presence, we have to be everywhere and all the time. So for us and what we deal with in multifamily, I'd say that's probably gone up a little bit to be doing it correctly and to be the best.
Okay. One in the back here.
Yeah, we are definitely seeing that. They definitely ask for it. So you really are, to compete, you really do need to have the biggest and the best and newest amenities. But you're right, they are empty quite often. But if you don't have them, you would lose customers and you would lose business. We try to promote it as much as we can, but I just think in this day and age, people are busy. They work a lot more. Both, everybody that lives in the apartment is working, as opposed to before, where somebody might have been home. So I just think folks are busy, but they do want those amenities. If you didn't have those, that would definitely be an issue and possibly lose business to your competitors.
In general, it's absolutely not about using them. Why would you possibly? There is certainly more demand on, what's the biggest amenity we have? It's a gym. What does everybody say every January? I'm going to work out every day this year. And the number of us that are doing Workout 365 on the 31st December. So, there is that demand to absolutely agree with Mischelle. If you don't have it, you're going to lose the lease to somebody that does. And if you don't have it, you're going to lose the sale of the property to somebody that does have it. But we are finding, as you take some of these, over the top and put, full kitchens in your cabanas by the pools, those get used a lot and have a lot more use in the pool. Spin classes, aerobics classes, they've largely gone away, and I think just about all of us are using fitness on demand. And again, it's tailoring yourself because, again, that spin or aerobics class, it's binary. Either you're available at 7:30 when that class begins or you're not. The fitness on demand, you can go into the room, you can go up to the computer, and you can say, I want a 30-minute class in Pilates at medium difficulty. Boom, and it's going in 30 seconds. Those get used. And so you're always thinking about, as Mischelle said, your resident doesn't have time. How do I make this quicker and easier on him or her and revolve around their schedule?
Yes, we're also seeing an uptick in the little virtual office pods. We're seeing those get used pretty frequently, and people won't sit in them all day, but they'll come in, they'll do a little bit of work, maybe school work, maybe their business. They come in and then they go. So it's like you're saying, it's what's convenient for them. And you won't see them in there all the time, and they won't likely be full. But people are popping in and using them here and there. And
the one amenity I will tell you that the residents absolutely use everywhere is the Starbucks coffee machine.
yes.
And you try and go and take away Starbucks coffee and put in Dunkin' Donuts coffee.
They know.
Take your life in your hands.
Yes.
You will have a revolt within minutes.
Yes, absolutely.
Allison.
This is for everybody. Have you noticed any changes in apartment unit types that have evolved? Because I know we've seen more of a demand for one-bedroom apartments because people don't want roommates anymore, or maybe three-bedroom apartments because families who typically were owning homes are now renting, and that the two-bedroom apartments are sometimes a little bit harder to sell. Are you seeing any changes overall in trends in what people want?
It changes. I think it changes seasonally. Sometimes we'll have a solid push for one bedrooms, and then that will change to two bedrooms. Three bedrooms, there's usually not as many of those, so those tend to stay full. But for us, it goes back and forth. But I think one bedrooms and studios, definitely we're seeing demand for that.
We see it different a lot by location. It used to always kind of be a little bit the economy. When the economy was good, one bedrooms were popular. Everybody would live by themselves. Economy goes bad, people double up, two bedrooms and the one bedrooms lay. We're really seeing it, by locations. In Boca Raton, we did, I think, 18% three bedrooms, which is high for us. We missed the mark. We could have done 30% and been, because we had a large number of people actually moving out of homes because their kids were gone. So I think, in more urban locations or even urban edge locations where you're appealing to a younger renter, two bedrooms are going to be popular. And even within the two bedrooms, you better have a split floor plan without a common wall. And if you can do a dual master where each one of those bedrooms, each one of those closets, each one of those bathrooms is exactly the same size, you got it. So I think it's going to be locationally driven and just knowing, who your renter is and what the point in their life cycle they are.
I agree.
Questions in the back?
For us, it's another one of those things that's like the amenities. So people want those, absolutely. It's something that you need to be competitive within your market. We don't find that everybody uses it. Again, it's another thing everybody wants, but not everybody uses. But certainly it's a great selling point. If you don't have it, it's something that's missed within your market.
Yeah, and I think we've been, and I've been wrongly pushing our guys that it's the wave that's coming. Someday I'll be right. What we're finding is, if you'll go above and beyond your competitive area and give it to people, they're happy. They won't pay for it. We've gone to several communities and put in a smart upgrade that'll control, doors, lights, just about obviously HVAC and all those things, and it's a very slick system, but nobody wants to pay for it, or very few.
In back.
There seems to be a push recently for different types of units between micro units, 55+ units, and even live-work type units. Are you guys seeing any of that in the markets you're working in? And what does that do to the overall price point of what you guys are doing on the
There was a very big push to the micro units. We're going to make these smaller and smaller and smaller. And if you look back over the past 70 or 80 years in America, much as our waistlines have gotten bigger, our homes have gotten bigger, our apartments have gotten bigger, everything's gotten bigger. And we saw it start on the West Coast and kind of push here that we're going to reverse this trend. And I think if you talk to the guys in Seattle and San Francisco that have been doing these now for 10 years, there are a couple of them that have stepped back and said, we did these and we were getting by far the highest rent per foot in these, and so we started doing more. And then after 4 or 5 years, we stood back and looked at it pretty carefully, and yeah, we're getting the highest rent. Your overall rent may be $2 and you may be getting $3.50, but it's also far and away our most expensive cost per foot to build. And what they also found is, which was really interesting to me, the turnover was exponential to the turnover in the rest of their community, because the whole idea was we're going to build these massive amenity areas, and everybody's going to commingle in the amenity area, and they're just going to go up to their apartment for 6 hours a day and sleep, and they don't care if it's 300 square feet. And all these 20-year-olds bought into that, moved in, and a year later, they're like, if I want to invite somebody over to my apartment to watch a game, I don't want to sit on the bed, and they moved out. And where normal turnovers 40, 50, 55%, these things were turning over at 90 and 100%. So long story, a little more painful. I think we are seeing a diet to the American apartment and the American home, and it's shrinking a little bit to try and balance affordability and cost. But I think personally, and this isn't even universal within our company, but personally, I think the micro units, the under 550, is a fad that when you very carefully dissect it is not economical.
I'd say we agree. I mean, we manage a couple, some of they're not necessarily microtel, but they're small 500 to 550 square foot apartments close to downtown Orlando, and there's not that many of them, so we do well. I think that's why. I think if it were oversaturated in the market, there wouldn't be a huge push or demand for those. I think we do well because we're the only ones there that do it, but they're not necessarily microtels. We're not including the utilities They're just small studio-sized apartments. But I agree. I think perhaps that, you know, in the more metro areas, maybe they're seeing more demand, maybe Chicago, New York, those types of places, but at least here in Orlando, we don't see, you know, the demand for those.
You know, the fundamentals are so strong that, no, I'm, you know, you hear it every year, but every year, you know, the apartment industry just continues. And if you look at this year nationally, I think or last year in 18, delivered 340,000 units. It's kind of a peak, and it's going to, you know, right now, you know, we were going to try and touch on costs, but costs have just gone. I mean, it's making it so difficult right now to underwrite and get deals approved. Construction lending is contracting. Equity's getting much more selective. The numbers are so thin right now because costs have just gone crazy. And just to give you an example, I was talking to a friend yesterday who's a developer up in Atlanta. He bought a site to do a project in 15, had some delays for various reasons. They priced it out without the land. This is just pure hard and soft costs, exclusive land, at $205 a foot. And now they've gotten a lot of their problems solved, and they're ready to go and have the capital, but that number today, 4 years later, is $275 a foot. So the run-up in costs is going to put a governor on supply, and all the data that you're reading is showing supply tapering off, you know, over the next 3 years, as it is getting extremely difficult because of the cost factor to build. Now, you know, if the construction industry starts to contract some and they start to come back and, you know, tamp down their pricing. You know, labor's a big one. Obviously, we've had materials in certain sectors of the materials due to tariffs and what have you, you know, has driven the whole cost structure up. And, you know, I touched on earlier the demand element. When you have these two massive cohorts that are leaning more towards into renting, the average millennial today is 31, right? So, you know, take 5 to 8 years on either side of that 31. And I have 2 daughters, and I don't think I'll ever be a grandparent, you know? I mean, it's like, it's not in their wheelhouse, right? They're both have careers, and, you know, they're going full steam ahead, and, you know, they've lived in each of them and separate from each other in 4 different cities over the last 6, 7 years. And they want mobility. And my one daughter was out in California living in Los Angeles, kind of right out, this is like 10, 11-ish. And I said, honey, see if you can find something for us to buy, you know, that, you know, maybe you can get some small number of units and rent them out or whatever to invest into this, you know, opportunity that exists. And that's the last thing I want to deal with. I don't want to own anything, Dad. You know, I want to have the mobility. And, you know, she graduates from Pittsburgh, goes to DC. From DC, she goes to LA. Now she's in San Francisco. And she's got her sights set on the next place. So she's 33. My youngest is 31. She graduates from here, goes to New York, spends 2 years in New York, then goes out to LA, spends 3 years in LA, comes back home to get her MBA, which she just got, and now she's moving to Atlanta this week. So the millennials like portability, and they don't have any stuff, right? That's not like the boomers who, you know, you go into their homes and it's just, stuff. It's like George Carlin, if you've seen his, you know,
a place for my stuff.
Gig on stuff. It's hysterical, but it's so true. You know, you go into a millennial's apartment, there's nothing. And they don't want anything. They want experiences and their Starbucks coffee and go on trips and, right? I mean, that's just the reality. So they're renting and they're getting married much later. And then when they get married, they're deciding to wait before they're going to start that family, which is the time that they'll go out and look to buy a house. So it's very different this generation. And then the boomers, they want the ease of living that these luxury communities and all the services that Mischelle and her staff do for their residents. You want to walk your dog? Sure, we'll walk your dog. You want us to water your plants? We'll water your plants. Dry cleaning, and we'll go get that for you. I mean, it's like the easiest lifestyle you could possibly have is living in one of these professionally managed communities. And the boomers, so the millennials, their children are now moved out of the house. They're sitting out in suburbia in an empty nest. And of course, it was great when the kids were there because they're doing all the sporting activities and they're involved in the school stuff and going to the productions at school and the plays and all that. Now the husband and wife are sitting there, you know, what are we doing out here? There's nothing for them to do. We go to the Publix and, you know, you don't go to the park anymore because you don't have kids to take to the park. So they're all coming back and wanting the more urban, you know, life experience of walkability. So like, you know, when we put together investors, the investors that are looking at our deals today, especially at the high end, they want to know what the walk score is. And that's really important, and that's the investor. But I can tell you that the boomer resident and the millennials, everybody wants walkability today. And they want to be able to come out of their apartment, walk to Starbucks, walk to the restaurant, walk to the latest brewery that just opened up, microbrewery. And so if you look at I know you hear this, how great apartments are, they're great, they're great, they're great. They are, and they're going to continue to be because the demand generators are so big and they're continuing to want, it's now become accepted. It's cool to rent. Whereas, you know, when I was getting out of college, it was like, you know, you're a renter? Oh. Today, you know, now it's just widely accepted, and it's actually an easier lifestyle than owning a home and dealing with all the crap you got to deal with. So supply's curtailing because of costs right now, and demand's increasing. It's supply demand, just like Dirk said in the previous session. This better be an easy one, John.
We're not yet, but the other thing, what you're going to see that when we as an apartment community, using the term generally all of us, can solve the Airbnb opportunity. Today, I'm sure you guys won't let anybody rent, and I can tell you why she won't. Because you can't do a criminal check.
Well, that, and then the long-term and the short-term profile, they don't mix well, so there's a lot of factors in that.
But there's tremendous demand from our residents. There's tremendous demand, you know, we're in a sharing jobber economy, and it's going to come. The biggest impediment is we as an owner and the insurance companies of our owners don't want anybody having access to that property that doesn't have a full resident screening. When we can, and Airbnb doesn't do that. When we can get that, you're going to see demand for furnished units. And but to your exact question, we aren't seeing you know, millennials come in and say, just arrived in town, here's my backpack, can I rent a furnished apartment?
No, it's still contained, really, those furnished units to traveling business corporate units. We still work with those, but it's not a large number. What we do see now, more so with the millennials, is your community located near a grocery store that delivers groceries? We get asked that all of the time. That's a big thing now, apparently. And not every place is, so it's interesting that's really a new thing for us, but not with the furniture so much, not with millennials yet.
We actually do have a couple, so I mentioned some of these 60s sort of downtown location buildings that we've bought, and not all property management companies are comfortable with Airbnb and things like that, but some are, and one of the managers that we use has an Airbnb division, and they manage homes and all the rest. And so we've started doing some of that. We had a deal in downtown Nashville that we bought that was very, very walkable, and that was our first foray into it. And we furnished the units, and I think market rent was like $1,800 a month, and we would rent it we would sign year leases with an Airbnb host. They would rent it from us for $2,200 a month. So it's a premium for us. We still have a year lease. They are managing, we do have transient people coming through, but for us, we weren't managing the process. So that was our first foray into it, and it was a $400 premium on, I think we did like a dozen units. And then we have a deal in downtown Louisville right now where we're directly next door to a brand new Omni. You can walk to 4th Street Live, which is sort of their entertainment district, and I think we've got maybe 20 or so studio units that we've furnished ourselves, and some of them are rented by Airbnb hosts who sublease, and others we do the subleasing directly to them. But for us, it's a matter of whether the management company...
Are you furnishing the units for them?
We furnish them.
You furnish them?
Yeah, we get the furnishings, and if the management company can wrap their heads around it and get comfortable with it, we're comfortable with it as an owner.
It's coming. I don't know how many in the room know this, but actually Airbnb owns an interest in 2 apartment communities, one of which is right here in Orlando and Kissimmee, and the other is actually, interestingly enough, in Nashville, and the name of the company escapes me, but their whole, thank you, Nito. Their whole business plan is we're going to take 100 units or so many units, and we're going to rent them to Airbnb hosts, and we're going to take a slice of the pie. Like I said, they're today our security, and like Mischelle said, resident permanence versus interactions that we still can't get comfortable with, but as I tell our management folks, the guy that figures it out first is going to win.
Exactly. That's what we're doing. We don't want to necessarily be the first movers within that platform, but we're just kind of sitting back and watching, and once somebody maybe perfects that or figures it out, maybe then we'll consider getting in there. But right now we're kind of sitting back and watching. There's a lot of risks, like you've said.
Sure. I would tell you, as a mixed-use retail developer, we make pretty good apartment developers. That has been our experience. We're forced to do it, and have done it in a number of locations. The one that still gives me a quiver, we were forced to do it probably about 13 years ago in Plantation, Florida, at the corner of Broward Boulevard and 441, which is a major intersection with a gazillion cars going on Broward and a gazillion too on 441. And how could retail not do well there? And we put in 17,000 square feet of unacred retail, and we owned the property for 10 years and leased that last bay right before we sold it. It's difficult. There are locations that it works. We're in Tampa today. And I don't know how many folks have seen our Altice Grand Central community going up across the street from the college and the Oxford Exchange. And you're part of that experience when we were first forced to do it is forced us to become more and more and more conservative. We're actually, there in Tampa, 120, 150 days from turning over the retail, and have more LOIs in than we have space at like $15 above our pro forma rental rate, which, you know, if they actually sign the leases and move in, will be, you know, I'll be doing cartwheels in the office. But in general, it's been very difficult.
That's a pretty unique location.
It is a pretty
Right.
unique location. To your point, in suburbia, you know, it doesn't work. We first started, in my career, first started seeing, I started with a company in Atlanta called Post Properties. We bought a company in Dallas called Columbus Properties, which were the pioneers. If any of you guys have spent time in Dallas in the uptown area, of redeveloping, and Roger Shaw, who started Columbus, was a pioneer that really turned that whole uptown area around. And what I figured out after a year or two is, as apartment developers, we can be a block off Main and Main, and people will come there and live there, and you know, the rents may be 5% less. And if we're 2 blocks, they may be 10% less. Well, for a retail developer, when you leave Main and Main, or you leave an anchored center with a Publix drawing you in there, you know, you don't go 5% less, you go 35% less. And when you get 2 blocks away, hell, you got to pay me to be in there.
If you're lucky to find that.
I currently don't have any within my portfolio now, and it's not been really prevalent for me in my experience. I've had a couple. I know we have Novel Lucerne close to downtown, and we've got Earth Fair going in, and that's going to be a huge success. I believe whatever your anchor store is makes a big difference as well. And I think with Earth Fair coming in there, and you know, maybe some other organic or clean living types of stores, then I think we'll be very successful. But again, I feel like exactly what you're saying, it's location, close to downtowns, or maybe even coastal. I've seen some success there with that. And for us, we just manage it. It's not a lot of overhead. It's very similar to what we do with the apartments, only probably less demanding with the day-to-day.
So I think we're running slightly over, and we don't want to preclude you from using your free drink tickets at the cocktail reception. Are there any other press questions that people have that they really would like to get answered? No? That's it? Well, thank you for attending.